Hello, it's Big Chads, and this is the Trading Encyclopedia Daily Education series on my YouTube, Chads Trading. Find me on Twitter at Big Chads and Bitcoin Live, where I'm a founding analyst. For today's lesson, we're going to talk about the concept of price levels and the difference between a slow bleed into a price level versus a quick test. So let's say we have a rather well-defined price level here. Let's say the price has established it over time. It set it, did whatever, it set it, and then it broke out. So here's our price level, and we're going to extend it out now that we've shown why it's important, how it's established. And let's say something happens here where the price rejects. Now, if the price drops quickly, you have a much better chance of the price level holding than if it slowly bleeds through and it starts to chop through the level. Why is that the case? Well, let me show you a quick AI overview. You can pause and, of course, read this on your own time, but it talks about the market psychology, and it talks about volume and trading implications, and you can read this on your own. But the idea is that, think about the Bollinger Bands, right? So you have, and we'll go back to that image, but let's say you have the Bollinger Bands. And when you have price movement outside of the Bollinger Bands, it's often a movement outside of a standard deviation of volatility, and the price will snap back into it, right? Versus when you're kind of slowly bleeding right along the Bollinger Bands, right? You don't necessarily snap back. So if you think about it that way, when you have a price, say you have this quick price drop, very likely the Bollinger Bands. Let's clean it up a little bit and we'll redraw it. And so we have our price level. And again, we know why it formed. Okay, and we'll draw it here. And so if the price is coming back down into it quickly, you're very likely dipping below the lower Bollinger Band. You're probably going to put in, Dragonfly Doji, Hammer, or, a series of lower shadowed candles. Okay. Whereas if you're kind of slow bleeding, by the time you're getting there, right? By the time you get there, there's no overreaction. It's just slowly trending. It will continue to trend down and break through it. So if you have a price level and you want to see it bounce and you think it should bounce and there's a reason why you're watching that level and it makes sense, you want to see it drop quickly because momentum snapbacks and momentum reversals give you good trading opportunities. So the concept in classical charting is that a slow bleed into a price level makes it much less likely to hold than a quick, sharp drop, an overreaction move that gives you a snap back in momentum, and it makes it a little bit easier to play. So that's the rule of thumb from classical charting in terms of price levels, slow bleed versus quickly dropping. And this is for the Trading Encyclopedia Daily Education series in my YouTube, Chads Trading. Find me on Twitter at Big Chads and Bitcoin Live, where I'm a founding analyst. Folks, thank you so much, and I'll talk to you soon. Big Chads out.